Right now, sovereign wealth funds and asset managers are pouring hundreds of billions into data center infrastructure. The artificial intelligence economy demands physical space, cooling, and power. Analysts point to a fragmenting global tech landscape where nations race to build localized computing hubs. But computing hubs are useless in isolation. The intelligence of the modern economy does not live in a single warehouse. It lives in the transit between them. It lives in the cloud. And the cloud is not in the sky. It is at the bottom of the ocean. It is made of glass threads, thinner than a human hair, wrapped in copper and steel, resting in the freezing silt of the Atlantic and the Pacific. Without these submarine fiber-optic cables, there is no global internet, no algorithmic trading, no artificial intelligence, and no modern financial system. But the infrastructure that holds the modern world together was not built by careful government planning. It was laid down in a frantic, desperate capital rush at the turn of the millennium, a rush that ended in a $22 billion crater. In 1997, a company called Global Crossing set out to wire the Earth.
They promised a private, high-speed network that would bypass slow state monopolies and carry the world into the digital age. They raised billions, laid 100,000 miles of glass across the seafloor, and briefly achieved a market valuation of $47 billion. Then, the math broke. The very cables they laid triggered a catastrophic collapse in prices, leading to desperate accounting illusions, a massive debt crisis, and one of the largest bankruptcies in corporate history. The investors were wiped out. The founders walked away with fortunes. But the glass remained in the water. This is the story of the $22 billion mirage that accidentally built the physical foundation of the modern internet.
To understand the scale of the disaster, you have to look at the physical bottleneck of the mid-1990s. The World Wide Web was waking up. Millions of people were buying personal computers, dialing into modems, and discovering a digital frontier. But the physical pipes carrying this new traffic were ancient. International communications relied heavily on copper telephone wires and a handful of early, low-capacity fiber cables owned by slow-moving government telecom consortiums. Making an international phone call was expensive. Sending data across the Atlantic was agonizingly slow. The infrastructure was built for voice, not video, not software, and certainly not the explosion of global commerce that technologists were predicting. Consider the reality of international telecommunications in the early 1990s. A consortium of state-backed entities controlled the major transatlantic cables, and they operated like a cartel. They kept prices artificially high to protect their domestic revenue streams. If a multinational corporation wanted to link its offices in London and New York, it had to negotiate complex, multi-year contracts and pay exorbitant fees for a sliver of bandwidth.
The system was rigid, defensive, and completely unprepared for the open architecture of the internet. The internet routes data dynamically, requiring massive, flexible pipes that can handle sudden surges in traffic. The old telecom cartels could not provide this. Their entire business model was predicated on scarcity. A narrative took hold on Wall Street and in Silicon Valley. Internet traffic was doubling every 100 days. It was a staggering statistic. If true, the world was about to run out of bandwidth. The old state-owned telecom monopolies moved too slowly to meet this projected demand. They required endless committees, international treaties, and years of bureaucratic approval just to lay a single wire. The market demanded a private solution, a company that could move at the speed of capital, lay cables aggressively, and own the data routes of the 21st century. The engineering challenge was monumental. Laying submarine cable is an industrial war against geography. You need specialized ships that cost tens of thousands of dollars a day to operate. You need massive spools of armored cable. You need underwater plows to bury the lines near the shore to protect them from fishing trawlers and ship anchors. And you need optical repeaters placed every 50 miles along the ocean floor to amplify the light signals so they do not fade into darkness before reaching the other side of the world. It is one of the most capital-intensive businesses on Earth. You must spend billions of dollars up front before a single customer can send a single byte of data. But in 1997, capital was cheap, and the fear of missing out on the internet boom overrode all conventional risk models. The world believed that whoever owned the physical pipes would tax the future of human communication. The stage was set for a visionary who understood exactly how to sell that future. Gary Winnick was not an engineer. He was not a computer scientist, and he had no background in telecommunications. He was a financier. In the 1980s, Winnick worked alongside Michael Milken at Drexel Burnham Lambert, the legendary investment bank that pioneered the use of high-yield junk bonds. Winnick learned a crucial lesson during his time in the junk bond trenches. Debt is a weapon. If you can convince investors of a grand enough vision, you can raise limitless amounts of borrowed money to build an empire overnight. In 1997, Winnick saw the bandwidth bottleneck not as a technical problem, but as a financial play. He founded Global Crossing with a simple, audacious pitch. The company would build the first privately financed global fiber-optic network. They would bypass the consortiums, lay the cable themselves, and sell the bandwidth to internet service providers, multinational corporations, and competing telecom companies. Winnick seeded the company with a $20 million investment, partnering with the Canadian bank CIBC. He then went to Wall Street and deployed his Drexel playbook. He issued billions of dollars in high-yield debt. The pitch was irresistible.
Global Crossing was not just an internet stock. It was the infrastructure that made the internet stocks possible. It was the pick and shovel play for the digital gold rush. Between 1998 and 2001, Global Crossing raised nearly $20 billion in debt and equity. The company moved with terrifying speed. They commissioned fleets of cable-laying ships. They laid the Atlantic Crossing 1 cable. They expanded to Europe, Asia, and Latin America. At its peak, the company had laid 100,000 miles of fiber, connecting 27 countries. The financial rewards were astronomical. Global Crossing went public in 1998. By 1999, its market capitalization soared to $47 billion. The culture inside Global Crossing reflected the absolute certainty of its founder. The company spared no expense. They built lavish corporate headquarters, hired top-tier executives away from established telecom giants with massive signing bonuses, and operated with the swagger of a company that believed it had solved the future. They were not just laying cable. They believed they were minting a new global reserve currency based on bandwidth.
Winnick himself became a symbol of the era's excess, a man whose net worth appeared to rise by $1 billion a week on paper. He bought a sprawling estate in Bel Air, cementing his status as one of the richest men in America. He had built a global utility in less than 3 years. But the valuation was based on a fatal assumption. The stock price assumed that the frantic projections of internet traffic growth would translate directly into cash flow. It assumed that every strand of glass dropped into the ocean would immediately find a paying customer. The turning point arrives quietly. It does not start with a stock market crash, but with a simple law of economics. Supply destroys price. By 2000, Global Crossing is not the only company laying cable. Rivals like WorldCom, Quest, and 360 Networks have all raised billions in debt and launched their own armadas of cable ships. The ocean floor is rapidly filling with glass. The industry has laid millions of miles of fiber in a matter of months. But the demand narrative is flawed. Internet traffic is growing, yes, but not doubling every 100 days. That statistic was a myth, an exaggeration born from a brief spike in early internet adoption. Worse, the technology of transmitting light through glass is improving exponentially. Engineers discover ways to push dozens of different wavelengths of light down a single fiber, multiplying the capacity of existing cables without laying a single new wire. Suddenly, there is a massive capacity glut. The world has built 20 years of bandwidth in 3 years. The price of transmitting data across the Atlantic plunges by 90%. For Global Crossing, this is a death sentence.
The company is carrying $12.4 billion in debt. They owe massive interest payments to their bondholders. To service that debt, they need cash flow, but the bandwidth they are selling is rapidly becoming worthless. And then the accounting alchemy begins. To hide the deteriorating core business, Global Crossing and its telecom rivals engage in a practice known as capacity swaps. They trade empty fiber networks with each other.
Global Crossing will sell the rights to use a segment of its European network to a rival like Quest for $100 million. On the exact same day, Global Crossing will buy a segment of Quest's American network for $100 million. No actual cash changes hands. The networks remain largely dark, unused by actual consumers. But on the financial statements, a miracle occurs. Global Crossing books the $100 million it received as immediate, high-margin revenue. Meanwhile, the $100 million it paid out is classified as a capital expenditure, slowly depreciated over 20 years.
Through these indefeasible rights of use, the telecom industry inflates its revenues by billions of dollars, creating the illusion of booming sales while the underlying cash flow bleeds out. The pressure inside the executive suites becomes unbearable. Executives realize that if they miss a single quarterly revenue target, their stock price will collapse, cutting off their ability to borrow more money. So they authorize deeper and more complex swaps. They trade routes across the Pacific for routes across the Atlantic. They trade capacity they do not need for capacity their competitors do not need. It operates exactly like a massive corporate check-kiting scheme. The numbers on the spreadsheets grow larger, but the bank accounts remain empty. By the time the Securities and Exchange Commission begins to investigate the accounting practices of the telecom industry, the damage is already irreversible. It is a house of cards built on hollow light. Wall Street analysts cheer the revenue growth, ignoring the reality that the companies are simply trading the same empty assets back and forth. But you cannot pay interest on $12 billion of debt with accounting revenue. You need real cash. By late 2001, the cash runs out. The telecom bubble bursts, taking the sector down with it. Lenders freeze credit lines. The capacity swap scheme is exposed by whistleblowers and aggressive short sellers. In January 2002, the illusion shatters. Global Crossing files for Chapter 11 bankruptcy. It lists $22.4 billion in assets, making it one of the largest corporate failures in history. Shareholders lose everything. Employees lose their jobs and their retirement savings. The $12 billion debt load crushes the company entirely. The collapse of Global Crossing leaves a bitter legacy. Gary Winnick, who had sold hundreds of millions of dollars of his own stock before the crash, walks away a remarkably wealthy man, though his reputation is permanently scarred. The bankruptcy wipes out billions in shareholder wealth and destroys the portfolios of ordinary investors who believed they were buying a piece of the internet bedrock. But when the dust settles, a strange paradox emerges in the freezing depths of the ocean. Global Crossing died. The debt was wiped out. The equity went to zero. But the glass remained. The ships had already done their work. The 100,000 miles of fiber-optic cable were safely buried beneath the Atlantic and the Pacific. In bankruptcy court, the physical network was sold for pennies on the dollar to a new holding company. Freed from the suffocating $12 billion debt load, the network was suddenly economically viable. It sat there, silently pulsing with light, waiting for the world to catch up. And eventually, the world did. The explosion of streaming video, the rise of smartphones, cloud computing, and today's artificial intelligence boom all required massive, cheap bandwidth. They required a global infrastructure that no single company could ever afford to build from scratch today. The modern digital economy is running on the sunken subsidies of the late 1990s. The investors of Global Crossing paid for the future, but they did not live to see the returns. It is the brutal mechanism of technological progress. Capital rushes in, builds the infrastructure in a frenzy of greed and delusion, and is subsequently destroyed when the bubble bursts. The survivors simply pick up the pieces and use the tools left behind. When you watch a video, execute a trade, or prompt an artificial intelligence, your data is traveling through the physical ruins of a $22 billion failure. Who really pays the price for the infrastructure that connects the world?